It's a firm start. It's a solid start. 50 points higher for the Nifty, but the market breadth absolutely near perfect. For every one stock that is going down, 11 stocks are going high. This is the kind of market breadth you saw at the, when we were in the 2021 kind of an epic bull run. You want to see such, more market, you want to see such broad participation. That in a sense will only induce more participation. Stocks and news, Bank of Baroda, 3% higher. Kotak Mahindra Bank, in terms of percentage, 75 rupees higher. Both these stocks are off to a good start. You want to also look at Zomato, simply because of price action, and the kind of price action what the stock saw yesterday is off to another good start. Domestic pharma companies could come out with good numbers, largely because considering that the quarter gone by, in a sense, unfortunate it may sound, but you did have a spike in viral and influenza cases. So companies like Cipla, Dr. Reddy, largely do these two. Sun also do some extent. These are companies which in a sense have a very strong anti-influenza portfolio. So those are the ones which actually would benefit. But the real top draw, Aisha, has to be Kotak Mahindra Bank.
Oh yeah, absolutely. Kotak Bank all the way. BOB, SBI, these are all the other banking names which are also in focus and holding out quite okay. For the Nifty as well, it's almost a 17,700 thereabout kind of start. I don't know whether this is the high point that we made yesterday or not, and have we opened above that level. We will just check in with our chartist. IRB Infra, the March toll collections have risen about almost 20.6%. They're almost at 370 crore rupees. So IRB Infra is the big mover this morning, 3.25% higher as we speak right now. And the IRB InvIT Fund as well, wherein the March gross total revenue has come in higher by about 9%. There's also Glenmark. That's another stock which is in focus. A couple of newspapers are reporting that they are looking at selling a majority stake in Glenmark Life. So Glenmark has started off almost 1% higher as we speak right now. And Shilpa Medicare too, which has got a recent US FDA nod for one of the tablets. Neogen Chemicals, we were highlighting this stock since yesterday, exclusive to us. They're looking to acquire manufacturing tech license for electrolytes from MU Iconic Solutions, or Ionic Solutions rather. Neogen starts off with a gap up 5% higher as we speak right now. But for the index, Kunal, what can you tell us? Where are we likely to head today?
So I think it's a good start again. 17,700 is where we are testing. So hopefully if we manage to sustain about those levels, then I think that mild bit of pause could probably be over for the indices, and we may expect a upward trend. Good set of large cap names participating back again on the indices. One of the stocks which I would be looking to recommend to clients, as well as being a bit more aggressive on the upside, would be RBL Bank. I think the stock is on the verge of a breakout about this 144 mark, inverted head and shoulder pattern. So that's a stock which I would be bullish on, would look to trade.
Okay, Naresh, what about your first trades? What are you punching in?
So adding on to Bharat Electronics, BEL, overall the PSU pack again has started looking interesting in terms of momentum. So BEL is again back above 100 levels, so that's a positive signal. So expecting this to go slowly towards 110 to 115 in the short term.
It's a good start, not for the index per se, but it's a good start at least for the broader market. And that is what you want to see. You want to see large-scale participation. You want to see broad participation. The small and the mid-cap indices also, frankly, where they were versus where they are now, it's not that expensive. Vineet Sambre joins us. Let's take our conversation forward. Vineet, good morning. Thank you for joining us. If you've gone through a period of lull and dull, it's been a dry patch for the market. Do you think we are nearing the end of this dry patch?
So Nikunj, good morning. I think, so first of all, if we have to just go back and see, I think last year, India particularly, relatively outperformed quite significantly versus the global markets. And I think in terms of the valuations, we were pretty on the high side, if we compare ourselves on absolute scale and also relatively. So I think from that perspective, this last maybe 6 months of consolidation has, and some bit of weakness, I think has come out quite well, when we think about the relative valuation and also absolute valuation. So I think from that perspective, that is the first important thing to focus on. The second thing which we are watching is clearly, I mean, there is some amount of moderation in growth across various categories is what we are seeing. And hence, from that perspective, I think we have to sort of rebase ourselves to slightly lower growth environment across the board. And I think from that perspective, the other matrix which right now is getting ignored is that there is a lot of focus on the top line growth, but at the margin, most of the companies, businesses have started talking about benefits of lower input cost, and this largely comes from lowering of the commodity price. The freight cost have come off, and the other important cost element which had risen significantly, those are sort of also moderating. So maybe what we will have over the next 1 year or 2 year would be, let's say, a slightly lower growth on the top line, but the bottom line should be pretty okay. So I think that is something which we have to select businesses and companies which have seen extraordinary cost impacting their profitability. Now those reversals taking place, I think there is maybe there could be that momentum there. The third aspect which I wanted to highlight is that I think this is a good type of a market to sort of deal with. One-sided rising market becomes very difficult. You are buying expensive stocks. Now at least one can think about being selective in terms of identifying businesses, companies which outperform and grow well, and maybe available at decent valuations as well. So I think broadly the next few months could be challenging, but it is also good for the investors from the reasonableness of valuation perspective.
Vineet, tell me a time when things are not challenging.
Sorry?
Tell me a time when things are not challenging. Things are always challenging.
Things are always challenging. It has to be that way, otherwise you won't get bargains.
But are you getting bargains in this market? I mean, is it a market where you are able to pick spots and treasure hunt?
See, let me say that definitely when it comes to good businesses with a long-term view and decent valuations, there are few pockets. I won't say that it's available in plenty. Healthcare has been one of our favored sectors for a while, and we've not. I mean, that sector has not performed as well. But I think now the time has come where the valuations have not moved high. They are quite reasonable. The cash flows, the ROEs of the businesses are decent, and now the growth also seems to be sort of coming back in a way which was, let's say, a bit slow in the last 1.5 year. So I think pockets like those. Then you have banking as a sector where things have materially changed positively, both in terms of growth, quality of assets, and the valuations. On the other hand, has been less than their long-term averages. So I think that's one pocket where I won't say it is bargain kind of levels, but these are attractive levels or reasonable levels, I would say, to look at. And then there could be one of categories like IT is now going through a phase where the valuations have corrected down. Maybe with the results coming out, there could be some more weakness in the sector, and that's where maybe the valuations become more reasonable. So I think that's how maybe we are thinking about opportunities across the board.
Okay. Last 12-18 months were all about buying commodity producers. Inflation was moving higher. It made sense, let's say, to buy a Coal India, ONGC. Do you think now the trade could reverse? It's time to go back to consumers, back to industrials, back to companies which essentially are large commodity consumers rather than producers?
Yeah, I would say so that now it's time for the commodity users. Maybe as we are seeing, as I said, a lot of the commodity has seen some correction, and with the world slowing down, definitely that's one of the big factors for the commodity is actually weakening. So I would say that the trade has to shift from. I mean, there was a massive scale up in the commodity prices, which was in a way becoming very difficult to pass on, and hence I would say that this trade has to shift. And as the normalization takes place, as the world sort of slows, the commodity would sort of weaken, and that would give way to the users of commodity, where they will see benefits in terms of the profitability.
Right. Vinit, I'm looking at your current holdings, and please correct me if I'm wrong, and I see a lot of pharma names. Do you think there is opportunity in the current, unfortunate rise that we are seeing in COVID, flu and influenza cases again, at least for the domestic generics?
I mean, see, these are maybe very short-term and one-off opportunities, which are very difficult to predict at how these things are going to have any bearing on the businesses. But I would say overall, we have started seeing the sector has started showing some growth. We saw the fourth quarter numbers of the by the trade bodies, and I think those are showcasing good growth. The other important factor to take a note of is large part of these of our Indian companies are actually targeting the US and the international markets. Now, interestingly, what is also happening in the US market, that market has also gone through a bit of a pain where the prices had collapsed because of the undue competition, and the buyers were consolidated. But now US is actually facing the highest amount of drug shortages, and I would say that this will give way for, and a lot of players have actually moved out because of unremunerative price points. So I would say this is actually building its own case for improved economics in the US market. And at the same time, if we look at as I was talking about the valuations have not gone anywhere because other sectors were doing well and this was getting ignored. So I would say the time for healthcare in general has come back, and if any of these opportunities come because of these one-off events, I think those will be added advantages, is what I can say.
What's the outlook, Vineet? Hi, morning. In terms of the kind of FII flows, the fact that we have seen, at least for the past few trading sessions, there has been, inflows coming in from the FII community. Do you think that valuations now for the markets are starting to look a little more reasonable? What's your sense as to how you expect the liquidity situation to shape up?
Yeah, you're right. In fact, I started with that. Last year was a year where we had seen unprecedented level of relative valuation contrast, where Indian markets were trading at a very expensive zone. But now, we have seen that, averaging out, where the world markets have maybe done slightly better, and our markets, we have seen weakness right now. So given that, development, our markets have become relatively much better in terms of the valuation zone. Secondly, I think the FIs have already done a huge amount of selling, and I believe that given the relative context, the relative valuation context, where we are today, it makes sense for some of these FIs to again start reevaluating the Indian markets, because while we may talk about the growth slowdown and the other geopolitical issues, but at the same time, Indian markets still continue to hold the prime position when it comes to the growth, maybe at a lower level. But world over, there are many more issues to be tackled, whereas in India, you have at least stability of policy and other visibility is slightly better. So I would sort of say that, for the FIs, I think it makes sense. There are a few of the FIs who we are also in touch, and our sense is that particularly they are looking at our markets at this juncture. So hopefully we will see trend reversals as far as the flows are concerned from the foreign investors.
Vinit, tell us a little bit more about the other small and mid-cap opportunities that you may be scouting right now, or at least sectors that you're keeping on your radar.
Yeah, so within the small and mid cap space, there are, these are more bottom up stories and not particularly coming out from what is happening in the current macro environment, but more from the long term, that, how these companies would sort of, grow and create wealth for the investors with a long term view. So from that perspective, there are times where there are many businesses which are going through a challenging phase, but we keep accumulating those, considering that those are temporary in nature, and this will eventually give us a good outcome over the long term. So I think from that perspective, I would say that auto ancillary particularly is a segment where we are holding a positive view, given that last 3 years were pretty bad, not only in the Indian auto markets but globally. And auto ancillary as a segment, I think they are catering to the world markets in a way. So there I believe there is a change. There is a this change of cycle from low point to high point over the next 2 to 3 years, and which is where we are sort of sensing some bit of the opportunity coming through. The other area where we believe is a large segment as far as India is concerned, there is big opportunity, but keeps going through volatility because of a lot of aspects. Agriculture is one area where we have a good long-term view. We like a lot of these companies are leading companies in their own categories within fertilizers, agrochem, and they have, in terms of business, they have done pretty well over the last 3-4 years. But in terms of the stock price performance, it has not been up to the mark. So we would say the valuations are reasonable in that segment, and we like many of these names within that pack because we see that as as I said, large opportunity out there, and which is where we are focusing on. Beyond that, I would say that consumption right now is a slow moving basket, and at the same time, we believe that, and there are reasons for that. I mean, we have the entry level, the rural economy, which is not doing well. But this is not going to be a permanent feature. I mean, consumption is going to be the important driver as far as India is concerned over the long term. So we are looking at opportunities within the broader consumption basket. If because of this slowdown, already we have seen the stocks have witnessed a good amount of correction, and valuations have become quite reasonable. So we are looking at opportunities within that. And lastly, I was talking of the IT sector there. As we go through the weaknesses over the next maybe 1 or 2 quarters, we see that there could be an opportunity which would emerge in that sector also. So I think these are some of the large sectors which can provide good wealth creation opportunities for long term from the mid cap and the small cap perspective.
Vineet, for sharing with us your outlook on valuations, sectors, and the markets as a whole. 17,700, it's 0.5% higher for the mid and the small caps. Shilpa Medicare is soaring about 10%. Adani Transmission, Total, as well as Green Energy, they're all up 5%. Union Bank, BOB, Central Bank, as well as UCO, those are some of the other smart movers in trade. But of course, we've got the latest edition of CEO at Work lined up for you, where we caught up with the Axis Bank MD and CEO, Amitabh Chaudhary, to understand the way forward for the industry and what the outlook is for one of the largest private banks in the country. He remains confident about gaining market share, saying that the bank is due for a re-rating. Listen in.
It is about how you manage an institution. You are aware that some of these crises can happen, geopolitically, globally, and some of it can come to India. So as long as you have prepared your institution to manage some of those crises, I think you will not only tide over it, you can actually find opportunities where you can get a disproportionate market share because suddenly some opportunity came up. So that's how we are looking at it. My view is that some of these crises might continue. Like, for example, people are saying that there could be a dominoes effect of this regional banking crisis. This can then go over to a lot of money which has been raised from the marketplace for investing in real estate funds, and you've seen some run on the real estate funds. You have seen what has happened to crypto. So as people have chased with excess money, excess returns, and when these returns don't come, and if everyone is trying to escape through the same door, there is a kind of a run on financial institutions or funds, and that's why this crisis happens. So my view is that there could be more like this, but the regulators know what they're doing. I think regulators have shown how quickly they've contained the crisis, so it should be manageable. Unless there are some real shocks, oil price going haywire, unless you have a real shock in terms of some political person doing something stupid in another part of the world, I would say that India is uniquely placed and very well placed. I think India has balanced this geopolitical tension very, very well. Full credit to the government. I think the regulator has done a great job. So for us, it is a great time to get it right. Now, how much the GDP growth would be, how will the inflation play out, how will this excess liquidity which RBI has been slowly withdrawing, how will that be managed, what will happen to the currency rate? These are some of the factors which all of the important players have to manage. But overall, India is very well placed, and that's why we said we are sitting on a great platform to capitalize on it.
Okay, we're on the right path, but my question is that is the peak of the best growth and profit behind us? And I'll give you, some factors here. Factor number one, interest rates sooner than later will peak out. That means peak margin expansion will not happen. Base effect somewhere will kick in, and also competition has only intensified within private banks to give loan to quality players.
So yes, I mean, you do get times when the cycles do help you in expanding your margins and things of that nature. But let's also not forget the fact that in any cycle, at any point in time, if given, for example, let's take Axis as a case, our market share in deposits is close to 5%, our market share in advances is close to 6%. Should I really be worried about, whether can I gain market share and can I do better than the industry? Well, if my platform is right, my strategy is right, I'm executing well, I should be able to gain market share, which should reflect in my increased profitability, which should reflect in being able to maintain margins. Now, this is subject to some number of factors I mentioned. And that's what I'm telling people within Axis, that if we have worked so hard to get the platform to this level, we should be able to, given where we are, should be able to build on it and do better than what we've done in the past. Why should I worry so much about whether 100 is going to 106.5 or is it going to 107 or 108? There is enough to be taken from 100 itself, and that's what we should be focused on.
So the basic thumb rule for Axis Bank historically has been that it's at a multiplier of 1.5. Will that be the thumb rule going forward as well?
Well, as I said, end of the day, when we talk about ranking also has somewhere market capitalization built in. So yeah, we would like ourselves to be rated at similar levels as some of my friendly banks are. We have work to do. Market needs to be convinced, and if the market is convinced, hopefully it will get re-rated on some day. I think we have to still do a lot of work, establish sustainability, more credibility, and as we do that, hopefully it will reflect in our multiples also. Till then, I have to keep working hard.
While growth is enviable right now, but the deposit growth is something which is, I won't say pathetic, but it is slightly poor. The gap between deposit growth and the credit growth, I guess, is the highest in last 10 years. Do you see that gap narrowing down, which means growth has to come down or deposits have to go up?
Well, it is narrowing down. You've already seen the credit growth come down a little bit in the last couple of quarters. We are predicting the credit growth to be in the 13 to 14% range next year. The deposit growth is obviously muted. This is not sustainable in the long run, that you have a jaw which is negative. The deposit growth should be slightly higher than the credit growth. So at some stage it has to turn. Hopefully some of the changes that have happened in the budget will support the deposit growth in the banking system. Our view is, and as you would see, while the bulk deposit rates had caught up with the increasing interest rates earlier, even the retail deposit rates, if you look at the retail deposits rates today, they've already reached the peak of the last cycle. Today, for example, Axis Bank is offering for 1 year 7.26%. The peak of the last cycle was 7.3. We're already there. So I do expect that in the system it might take a couple of quarters to play out, but hopefully people will see value in putting money back into the banking system and the deposits, because some of the alternates might be as expensive or giving the similar returns as what the banking system is giving. And if it does not happen, well, at some stage the credit growth has to be tempered. There are no two ways about it. But all of us are also at the same time ensuring that we are expanding our physical infrastructure. We are spending a lot of money in digitally also, so that we can reach out to more customers. And as that happens, hopefully that will continue to give a fillip to the deposit growth. But right now, deposit growth is a problem in the system, and we do need to solve it. We need to get it back. Otherwise, at some stage, it will hit our ability to increase the credit growth.
So are you rejecting more loans and giving approvals for less loans?
We are very clear that the loan has to come at the right price and the right risk-adjusted return on capital. That's why if you look at Axis Bank's performance, you will see that on the large corporate side, our credit growth was limited because we were not getting the right price. Now, in the last couple of quarters, we've seen the price come back. You will see that our loan growth is also kind of picked up. So we are quite clear that we need to get the right return for the money we are giving out in the marketplace. That does not mean that we don't do fine pricing, but the overall mix has to make sense to us. And we have worked very hard to get our net interest margins from where they were to where we are now. We would like to maintain them in the same zone rather than just in the desire to get growth, giving it away and unnecessarily putting pressure on ourselves. So we have created the right operating leverage. We would like to maintain it.
You did get an advantage in last 2 quarters because of the interest rate cycle. What would be the lever for Axis Bank going forward to maintain and expand margins?
Well, beyond a point, just expanding margins does not make sense. So as we have said, in the long run, we wanted our margins to be around 3.8% and above. We've already reached 4.2% if I take out the one-offs. So we are already above the zone. So I have some margin to play with. And our view is that we will work very hard to ensure that we remain in that same zone.
Given that fintechs are now challenging the entire structure and the commission structure, how will that change life for Axis Bank?
So yes, you will always have new players coming in who will challenge the incumbents, and invariably they will go after the so-called what they see as the juiciest parts of the business. Please understand that banks are not just sitting and allowing the fintechs to come in and take over the juiciest customers. We are also investing in the digital side of the business in a very, very big way. And I think as time progresses, fintechs will find it more and more difficult. Secondly, I think fintechs are also realizing that RBI has placed clear rules in terms of how they can and should engage with the customers. If they want to engage with the customers in a certain manner, there is a front door through which they need to come and take a license and then follow the norms of what the license are. You can't stay outside the financial system and get the benefit of this financial system for free. You need to play it in a certain way. That playing means that it requires higher costs because you need to serve the customer well. You need to, if the customer has a complaint, you need to cater to it. There are certain collection methods you need to use to be able to collect the money from the customers, which means you need to play the game in a certain way. So that's the second part. I mean, the fintechs is not just about going and making money. There are certain costs associated with it, which fintechs thought they don't have to incur when they entered the business. Again, here, if you look at, for example, the kind of investments we're making on the retail side, we believe that in many cases we will give run for the money to the fintechs because they are in direct competition with us. In many cases, it makes sense for us to actually partner with them because they become not only we can take products to the marketplace with them, which make more sense to the customer. In many cases, they become a front end for us to source customers. And there will be a scenario where in some cases we'll take stakes in some of those fintechs because we might never attack the set of customers they're attacking and learn with them and work with them to ensure that they become successful. And if they become successful, we'll also become successful over a period of time. So you have to play an open architecture play where you compete, you partner, and you take stakes. And we're doing all of it.
So before we move to the part B of our interview, can I say that the fintech space is like a engineering marvel. It's like a Ferrari, but not fit for Indian roads. Indian roads still need a Alto, and that's what banks will provide.
No. There will be some fintechs which will be very successful. I don't want to say that fintechs are no, they will in some cases become extremely successful and they will emerge as a clear competition for banks. But there will only that many fintechs who will be able to scale and play that game to that extent. But the Indian financial system is large enough to absorb why do few fintechs?
Mr. Chaudhary, every time when we've spoken to the management and the promoters of companies, they said, look, we don't look at the stock price. It is a function of market, and market is something which is based on sentiment, valuation, a lot of multiple factors, and we grant it to them. But for bankers, it's important to look at the stock price because that's how you raise capital. Do you look at your stock price every day?
No, I don't. I've learned the hard way. There's no point in looking at the stock price. Yes, obviously when you're growing and you're growing at a pace where you're consuming capital, you do need to raise stock price. In the 3.5 years I've been here, we have raised capital twice, 22,500 crores. That's not a small sum of money. We have just acquired Citi, paid 11,600 crores for it. And if we continue to grow at a certain pace, at some stage in the future, sometime we might have to raise capital. Don't see the need now, but sometime we might have to raise capital. So yes, in that sense, the stock price is important. In that sense, you want to raise it at the right time, at the right price, so that the existing shareholders also benefit. And you also give an opportunity to the new shareholders to make money if you leave some room for the stock price to grow. But no, definitely don't watch it.
Which are the businesses where you think you have the right to win? You would like to be 1, 2 or 3?
No, we have in each of our key businesses, we believe we have the right to win because we are such a large group and we have all the elements in place. So you mentioned credit cards business. Why did we acquire Citi? One of the reasons we acquired credit card business was to become and grow our ranking. We already, our overall book size in credit cards has gone up by 40%. Our spend share has gone up from 11 to 16%. We believe on the acquisition side on a month-to-month basis, we are number 1 or number 2 player now. So that's one business we want to grow. Burgundy Private is one business we want to grow. I think on the retail asset side, there are some specific elements which are very, very dear to us. If you look at the combination of mid-corporate, what we call the SME business and the small business banking, our share of the overall loan book is already up to 20% because that's something which we focused on. We believe that's a business we can really rule in the marketplace. Bharat Bank we have talked to you about, customer obsession we have talked to you about, and customer obsession is a multiplicative factor which will feed to every business of ours. If people on the street say, go for customer experience to access, a wholesale customer wants it, a retail customer wants it, a SME customer, everyone wants it. Everyone wants a greater customer experience. So there are some of these transformation projects which we believe will feed into every business of ours. As I said, sky is the limit. We are not going to stop. Our aspirations are high. We want to keep pushing ourselves.
But I want to go back to that whole ranking aspect. Define ranking for me. Is it market cap? Is it profit? Is it customer satisfaction? What is that number for you?
So we, to translate that number into something people could relate to, actually said 18% ROE is what we want to aim for. 18% ROE was, we had never come even close to that number.
Exactly.
And you will see over the last couple of quarters, we have started hitting that number. before you say it. Yes, helped partly by the expansion we got on the.
Is that sustainable?
We intend to keep it sustainable. It is going to be a tough task. It's an aspirational number we put out there. But we believe and we know what elements we need to work on to sustain it at a certain level. Our net interest margins have helped us. We have had historical low credit costs. They will go up at some stage. So this rising credit costs have to be substituted with gain somewhere else. And we know where potentially we can gain, and we have to gain to keep it at the 18% level. Work is on.
There are a lot of benchmarks in which you are at par with the best banks in India. NIMS, for example, credit growth, even though on your book size, which is a reasonably large book size, credit growth is very impressive. But when it comes to cost, the numbers are not the best in the industry. Why is that?
Well, we have a historical context. If you look at our productivity of our branches, for example, it's not the highest in the industry. We have some work to do there. We also, if you look at the productivity of our sales force in general, it's slightly higher. It does happen when you are number 3 player and you have reached a certain level of scale, for the full scaling benefits have not come through. I think in some cases we were slightly behind the technology. We have caught up now, so those benefits start coming through us. Today, also, when you say, for example, a corporate salary franchise is weaker than some of the others, I think as we continue to gain market share there, have we reached a stage where business is coming to us because we are standing at the right place? I think we need to get to that place where we get our fair share because we're just standing. We're not there as yet. And I think once we get to that, our cost will look similar to others.
How far are you away from that point?
Oh, hopefully, let's see. It is only a couple of years, but only time will tell.
Still a couple of years.
Oh yes, it is a long haul. It's a big ship. For everyone, it's a big ship. And by the way, competition is not just standing there. We have tough competition, smart competition, and they are also doing their bit. I mean, they also hopefully are talking more about us than before. And when they talk more about us, they are reacting to some of the stuff which we are doing. They're not going to just sit there and allow us to take the market share away. So we have to work harder.
I go back to again a very basic question, which is that COVID was an eye-opener for us. The term I used was survival, then it became revival, and then a year ago it feels like a sugar rush. Is that sugar rush, both in terms of demand, credit growth, economic offtake, is that sugar rush behind us? Now are we in for normal years of growth?
I think we are in for normal years for growth because yes, COVID, there was a suppressed demand which did take off and it reflected in the GDP growth rate. It is hopefully going to normalize now. And from here on, depending on how India does and geopolitically how things play out, things will get normal. And frankly, we are in the risk-taking business, but at the same time, we are the risk management business also. We cannot allow the sugar rush to continue for too long because if we do, we will end up making the same mistakes what we've done in the past. I mean, I've said before that are we making the mistakes today which will lead to a problem 3 to 5 years down the line? We should keep asking ourselves this question. We do try to enact this, and we believe that today we are not, but firstly, time will tell. Secondly, you have to keep looking for things where things could go wrong. And that's part of the job of the management team, to keep asking themselves the question, is there something happening out there today which could lead to a problem tomorrow? And you have to keep, obviously, proactively managing it.
But has life really normalized for Axis Bank in real terms? I remember we had long, engaging conversations during COVID. We were all sitting at home. Banks' branches were half open. There were a 2-day week or a 3-day week. Now everything is normal. It's the same buzz and the same hum which is back. Have those lot of COVID assumptions been rebooted?
No, we did change quite a bit because of COVID. In June 21, we had announced that we will move to a 2-day roster week. We have not changed from that.
We're still following it.
Yeah, we're still following it. Yes, more people do end up coming in office because people do want face-to-face meetings. But if there is someone who does not have face-to-face meetings, can come to office only twice a week and it's all fine, because COVID did prove to us that it's not required that we will be present here just for the sake of being present here. So we have kept to that promise, though a lot of our employees initially did not believe it. We have not changed. Yes, this question keeps coming up that should we change that 2 to 3. We are still trying to look at the data and see what is telling us.
So you come to this office only twice a week?
No. Sometimes I end up coming more often, but I'm talking about the larger set. We also have more than 3,500 employees who have permanently shifted to home. Okay. We're not asking them to come to office at all. There is another set of employees we call gig employees who are working on gig basis, sitting from anywhere in the country. So we have done some things and changed some things permanently. It's not just one time, and we will continue to build on that as we move forward. So yes, COVID has brought about a clear change in how we work.
Couple of last follow-up questions, and I'll not extend my interview beyond that. Walk us through a mega trend, and I'll take the clock back before you take it forward. 20 years ago, digital banking was a novelty. Now it is a necessity. 5 years from now, 10 years from now, what is that mega trend which you see will emerge in the banking sector, especially in India?
Well, one of the things two things we need to think about. One, while data is ubiquitous, it is not necessarily available at the right time to the right people. I think the way the government is going about it and the kind of platforms they've created, data will give you insights which are not available today. So it is not only about the fact that the data is available. I think the trend would be who can use data in the best possible form and shape, and what are the use cases you build with it. Whoever is able to do that will be the winner in the marketplace. Second, I think what AI seems to be telling us today is scary.
Too much of data, but?
Well, my worry is that a lot of the use cases will emerge and the hoopla around it in terms of what AI can do and what you really need to, potentially how you take it to the customer and how you use it, will lead to circumstances, situation where if you're not in it, there'll be a problem. If you're too much in it, it could also create a problem. So you need to watch how it plays out, but I would say that could be a huge mega trend. I recently read this article in New York Times about how a chatbot responded about trying to be independent and stuff like that. So some of the stuff is scary. A lot of people who understand some of these trends have written to US government saying that they need to control it. But it is a trend which does need to be watched out for. If you recall, a couple of years back, it was all about Meta and the Meta world. I mean, now I think that noise has died down a little bit. But that could be another trend which could emerge over a period of time. I don't know how the millennials, the future millennials will like to lead their lives. And the way the trends are emerging and how quickly they have emerged just tells you one thing, that we today don't even know what some of those mega trends could be which could change the life of how we live and how the banks have to react to it and manage their customers. So you just have to be ready for the tsunami. You need to be standing in the right place so you can manage that tsunami as and when it comes.
Okay, so this is not a tsunami, but more like a rapid fire question. I'll throw some names at you, some sentences at you, and you'll have to give me your reaction. And of course, this is something I've not discussed with Mr. Chaudhary, so this is going to be straight out of his gut. Aditya Puri.
World-class franchise builder.
Shaktikanta Das.
Strong, steady hand.
Infosys when you're managing Progeon.
Oh, one of the best times I had.
HDFC Life.
Another great innings for me, a lot of learning.
Axis Bank, HDFC Life, Infosys, best stock to buy.
Obviously Axis Bank. What else am I supposed to say?
Axis Bank, what's the first thing that comes to your mind?
Thoroughly enjoying it, looking forward to more.
Extension? Chat GTP.
Interesting and worrisome.
When you're not thinking, what are you doing?
Oh, listening to music, reading books.
One book which you've read again and again.
No, I'm not there as yet, but I need to read a book again and again. No. Enough books to read.
Which is your all-time favorite book?
Rise and Fall of the Third Reich, because I think it gave me a very different perspective on what the World War was about. I used to be a great Osho fan, so a number of Osho books were quite revealing.
What's that one thing you think has been the most challenging time for you in your current tenure?
Well, I think the acquisition of Citi was quite challenging because we did it at a time when, firstly, we did it in a time frame which was shorter than what we had told the market. This institution has been around for 120 years, deal of a lifetime. We got 97% of employees to come and join us. The day one went extremely well. Looking forward to the next 12 months when we'll have transitioned the customers to Axis Bank platform. Very, very complex deal, not difficult, complex deal. And I think I'm very happy that we have done a great job till now. I think half of it is over. The more important half is still to be done.
Back with the market, right here in ET now, let's in fact revisit what the first trades have settled in at. And after a positive start, we've actually managed to hold up about almost 0.5%. 17,777 is where we're currently at in trades. So good 0.5% up in the green. Kotak Bank powering ahead by 4.25%. Canara Bank, BOB, Manappuram. These are all spaces which are looking very, very smart. In fact, there is a good move even on an SBI. ITC is also a contributor to the market movement today, as is the case with Maruti as well as Bajaj Auto too. But let's shift focus to ethos. Let's try and understand how is it that one is seeing India's luxury watch market. What are the demand, growth and margin trends that they also foresee? We have with us Yashovardhan Saboo, the chairman and MD at Ethos, joining in on the show right now. Mr. Sabu, great to have you today on ET Now. Morning, firstly. You know, you've seen strong growth momentum, and that's clearly continued in the fourth quarter as well. Tell us about what the demand trends are, and is there a slowdown at all when it comes to the luxury market? Because what one is seeing from, be it the travel trends, be it what the hotel data or hospitality sector data seems to be suggesting, there doesn't seem to be any slowdown.
Well, we've been seeing a very robust growth in demand actually continuously over the last 6 quarters. And of course, says that in any fears that the recovery that started, 6 quarters ago was, temporary or just a result of COVID ending, pent up demand. On the contrary, we see this as being sustained, and this is a symptom, or it's a sign of a very structural change in India in the buying of luxury, especially luxury watches. First of all, buying is shifting from outside India to India. It's shifting from buying unorganized to organized, and of course, due to the fact that the country's GDP is growing, it's above a threshold where discretionary spend takes off. We're seeing this robust demand. In a way, it's not surprising because this has been seen across the country, across the world, in many, many countries, and it's coming to India now.
What has changed after COVID that suddenly the demand for luxury is unprecedented? It's not that everything in the economy is doing well. It is not that only rich people are getting richer. But the difference in the demand, at least at the luxury end, is absolutely unfathomable.
Well, I want to say this, that it may seem as a kink or, a break that happened due to COVID and suddenly it's expanding faster. I don't think it's really that. Maybe COVID has contributed to, through social media, which took off at the same time, through people learning, especially young people, getting enamored with watches becoming a collectible. There are very few things, especially for men, that you can collect and keep for a generation and it still holds value. Several times it gains value. And these are things which are becoming popular because of social media. And I think that is what is the real change. Besides the fact that people got used to buying in India. People were buying expensive watches when they were traveling. But now they realize that buying in India is actually offering many advantages. The prices are competitive. You get all the papers. It holds value better when you have all the papers, and you get much easier after-sales service. So many reasons why this market is actually structurally changing for a very higher rate of growth than has been historically prevalent.
What are your top 3 selling brands, and what kind of existing relationship do you have with those top 3 brands? Are these relationships which are going to be multi-year exclusive relationships?
Well, without naming any specific brands, I think there is, in the public domain, there is enough information about what are the top brands globally. And in India, it's not really different. These brands, which are, the top 5 brands globally, are also among the top in India, if they are available in India. Some of these brands are not yet available in India. And our arrangement with many of these brands, if I go from, let's say, top 3 to top 10 brands of ours, in some cases, the relationships are exclusive. Of course, they are governed by agreements which are renewed from time to time, and in other cases they are non-exclusive. So we are a retailer, but in all those cases, we are usually or almost invariably we are the largest partner of the brand in India.
Mr. Sabu, hi. Let's also understand your outlook when it comes to the guidance, 15 to 20% same-store sales growth. Are you on track to maintaining this, or are you upping your guidance?
Well, we've had a very strong growth in Q4, and the same-store growth has been extremely strong as well. Over the next 3 years, we believe our goal is to grow at least 20 to 25% overall growth, not same-store growth. Same-store growth, I think, will rather be in the 15% range. However, a more specific guidance for the current year, I think we'll be able to give when we share the Q4 audited results. And I'm hoping it's going to be more than the average that we're going to keep for the next 3 years.
How does the margin picture evolve in a business like yours? Is it a fixed margin business, or depending on the brand and the category, the margins may vary?
Of course, they vary depending on brands. It's common sense. I mean, the best selling brands typically would have a slightly lower margin than brands that are not that well known. So there is a variation brand wise. And of course, in India, the overall margin is slightly lower than global margins for retailers, owing to the fact that we have a certain import duty to absorb, while the final prices, as I already mentioned, the final prices of watches in India are actually no different from what you'd find in a Dubai or a Zurich or a London or a Singapore. So in all the shopping destinations worldwide, the final prices are more or less the same. In fact, India may be a shade cheaper than most of the other locations. And you have to absorb the import duty. So it means that the retail margin is slightly lower than what it is internationally. But overall, yeah, that's pretty much the scenario. I think we are at a good wicket as far as the margin is concerned. You will see a growth in the margin over the last couple of years, and we are at a margin level which is probably stable now in terms of gross margins. In terms of operating margins, I think with operating leverage kicking in, we do anticipate the margin at the EBITDA level to keep going over the next 2 to 3 years, keep going up.
Would that go higher? That's my next question. So one is that you enjoy margins when you, those are margins which you get from the manufacturers, the watch companies. Second is that you obviously would have a flavor of your own interplay in terms of profitability, maximization, scale and size. When you say that your gross margins will go higher, is this largely because you're expanding and that's the reason why leverage would kick in?
That's right. So our operating EBITDA margins are likely to go up because we have a pretty aggressive expansion plan. We are very excited about it. We expanded to 3 new cities in the last 6 months. In the next 9 months, we have another 4 cities and at least another 15 to 18 stores to grow into over the next 9 to 12 months. Hopefully, the new malls that we are in will come up in time. So we've got a pretty aggressive growth plan. And if you sort of combine that with the same store growth that we hope to achieve, we've got a good growth potential there.
Same store sales growth around 15%. What about the outlook in terms of, overall for FY23? Because you have seen a 35% growth. Is this looking sustainable for FY24?
Well, beginning of the year, we had given a guidance of 30 to 35% for FY23. And we're happy that we're actually up there and, we are beyond the maximum range that we had given. So we're at about 36.7% or something like that. For the next 3 years, we've set a goal of about 20 to 25% growth. The specific guidance for the current year, I'd wait until we do our Q4 full reporting, and I'm hoping that it's going to be more than the average that we've set for the next 3 years. So let's say more in the 25% range.
Quick word then on premiumization, whether or not that's reaching tier 2 and 3 cities and what your store expansion strategy is?
That's actually the most exciting part of all what's happening in tier 2 and tier 3 cities. We've got a very powerful internet engine, which is source of data. We have leads coming in, practically 80,000 leads a day. And a lot of these leads are now coming in from tier 2 and tier 3 cities, which give us a lot of data. There is interest in watches, and not only a few of the best known brands. There is interest and knowledge about watches, which is growing. And that is encouraging us to sort of make moves and establish stores in cities, new cities. So on the anvil now are 4 cities this year: Surat, Raipur, Kochi, and Bhubaneswar. We've already started in the last 6 months. Indore, Siliguri, and Bhopal. Bhopal actually we exited 5 years back. We're back there. And the stores are actually starting to do well, within the first quarter itself. So these are cities where we see a lot of potential. There is already a lot of wealth. And what has happened now is that there is interest in watches. There's knowledge about watches. There's a desire to know more about watches, collect watches. And this is an amazing development.
Okay, Mr. Sabu, great to have you on the show today. Thank you so much for taking the time out. Okay, let's move on. Let's talk about the next triggers in the market. By the way, we've settled a good 100 points higher right now for the index futures. 17,788 is where we're currently at. So you've got 17,800 now in sight. In fact, holding out quite nicely and comfortably. It's banks once again which are actually leading the markets higher. But what about IT? That's the next one to report its numbers, or rather first one to report its numbers. It's going to be a traditionally weak quarter as it is. So let's take it across to Anisha, find out what are the other expectations.
Oh, well, yes, IT sector is all set to start the earnings season. Tomorrow we'll get the numbers from TCS post-market, so that's the key talking point in the market. But as you pointed out, it's a seasonally weak quarter, and this time around the revenue conversion has been slower than usual, and that's because there has been a macroeconomic slowdown across the board. So the deal signings have been a tad bit delayed, and the revenue conversion too is a tad bit slower, and that's why we are going to see very tepid growth on the top line across all IT companies. If you look at the expectation as far as the constant currency growth is concerned, it's TCS which is likely to lead from the front with a growth of almost 1% coming in. But then there are a couple of companies like TCS as well as Wipro which are likely to perhaps report a bit of a decline when it comes to the top line in the quarter gone by. So that's something that we are watching out for. And Tech Mahindra too is expected to be tepid. As far as the margin profile is concerned, we are expecting some sort of improvement there across the board. It will be larger in the mid-cap companies, but even for the large caps, there is going to be improvement of around 40 to 60 basis points when it comes to TCS as well. Infosys too is expected to report healthy improvement in margins, and that will be driven by improvement in utilization. We know that in last year there was a lot of headcount and fresher addition that had happened. That will start participating into the revenues this time around, and that's why the margin is expected to be better. Plus the currency tailwinds this time around is at a 10-quarter high, so that is something that will again support the margin profile of all the companies going forward. But the key, of course, this time around will be on the expectation of how FY24 is likely to pan out, because double-digit growth was a given in FY23. Whether it will continue in FY24 or not is the key talking point. The expectation is it's not going to continue. For Infosys, for instance, we're expecting that the revenue growth guidance will be around 5 to 7% with a margin band of 21 to 23%. For HCL Tech, 2 or 6 to 8% growth will be something that the street will be okay with. The margin is expected to be around 18 to 20%. So very similar to what they did in FY23 itself. For Wipro, there could be a guidance of Q1 FY24 which might tell you about a decline of 1% to a growth of around 1%, so a bit of a broad range coming in. And of course, with respect to TCS as well, it's expected that double-digit growth will not continue, but single-digit of around 5 to 8% is what is expected. Having said all of that, the valuations have become a lot more comfortable. Remember, during the peak times, we had seen the multiples going as high as 30 to 34 times. It's come all the way down to around 24 times as of now. While if you look at the 5-year averages, the likes of TCS and Infosys are trading below the 5-year averages, while a couple of them, HCL Tech, Tech Mahindra, etc., are very close to the 5-year averages. So a lot of decline from the highest point of the multiples, but in line with what we have seen over the 5-year as well. Specifically talking about TCS as well, with the numbers are expected tomorrow. TCS is likely to lead the revenue growth with a number of around 1.1% on the top line. Margin expansion to 40 to 60 basis points. But the eye would be on the management transition, the headcount addition, as well as the possibility of buyback, because ICICI Securities there is expecting a 20,000 crore buyback. So that is something that I'm watching out for.
We'll leave it at that, Anisha. That's the expectation coming in from the IT majors. But let's also get you some chartbuster ideas, but that we're going to do after this very quick break. Back with first trades right here in ET now. First trades looking extremely robust, 100 points higher right now for the Nifty as we speak, and a comfortable move above the 17,700 mark. Let's then address the chart busters, and Kunal has picked out Reliance Industries. Kunal, what do you read on the charts for Reliance?
So we all know, Aisha, that Reliance has played a major role in the pickup of this move on the indices from 16,800 to now 17,700 plus levels where we are trading right now. But the charts for Reliance are also very interesting on the short-term charts. And the only technical indicator which I wanted to showcase was a set of a bullish RSI divergence. So this was the move for the indicator for Reliance Industries in the month of January and February start, where the indicator made a fresh low. The stock was almost at 2,300 levels at that point of time. And then in the next move, when the stock made a new low for itself, fell below the 100-point mark from the 2,300 levels to sub 2,200 levels. That was the point where the indicator actually made a higher low. Now this in classical terms, we call it as a bullish RSI divergence, where the RSI tends to make a higher low, but the prices tend to make a lower low for themselves. This in effect, leads into strong bottom formation for the stock prices. Now, the first targets which we set in for the stock is closer to this, breakout on the RSI, which comes closer to 2400, 2450 mark for Reliance Industries, which means at current levels of 2300 approximately, there is room for another 100 to 150 points on the upside for the stock before it tries to face a near-term resistance. So, for a short-term trader, this indicates that the market uptrend could continue for some more time. 2450 is an immediate target for Reliance Industries.
Okay, 2450 on the radar for Reliance. Let's take it across to Naresh, find out what's the chartbuster idea that he's spotting. Naresh?
So taking a big contra bet here on Zomato. Now, if you look at Zomato, the stock corrected all the way down to sub 45 to 40 levels. That was the time major volumes were done and a base was created. Before that, in May of last year, the bottom was around 50. Post that, we saw recovery to 70 both the times. And now it drifted over towards that 50 to 45 mark again in February of this year. Over the last couple of months, it has made 3 to 4 bottoms around that 50 mark. And in the last two sessions, it has seen some volume and price action. 55 to 57 is a price point where it breaks out from. Sustaining above that, it could go back to 70 levels. So it's a risk-reward trade wherein at current levels, the stop loss at 50, stop loss is 50 and a target price would be 70 plus. So an interesting trade, 1 year of consolidation and a sideways phase done, could be setting up for the move towards 70 plus in the short to medium term.
Let's get in some stock-specific ideas as well. Kunal, on your list?
So, first one is a buy on Canara Bank. PSU banking stocks are making dash back again. Canara Bank is on the verge of breakout of 290 mark. So, would suggest a buy with a target of 300, stop loss at 284. And Dr. Reddy apparently has come back into an overbought nature in terms of indicators. So, would suggest a sell, targets of 46.80, stop loss at 48.70.
Right. And Naresh, what about your ideas?
So first would be a buy on Tata Chemicals, which has seen momentum in the last few sessions, a stop loss at 980 and a target price of 1100. Second is a buy on Canara Bank, a momentum trade here as well, a stop loss at 285 and a target price of 320.
All right, markets are holding on 700 points plus for the Nifty from the recent low, 1700 points almost for the Bank Nifty from the recent low. Blink of an eye and this market is now just looking strikingly different. A week ago there was hesitation. 2 weeks ago, there was bearishness. 3 weeks ago, there was confusion. But 3 months from now and 6 months from now, for those who bought the fall in the month of March, will they be rewarded? Or this is one of those rallies where if you raise some cash, you would be rewarded. So let's talk markets and understand valuations. Vinod Karki joins us now. The fear of unknown eliminating from the global markets could force a type 1 error in gauging domestic economic activity. Now, for our viewers, it's too technical. So let's understand your market thoughts right now.
Hi, Nikunj. Yeah. No, so actually the technical term, it makes it look as if it's some complicated thing. Only the basic thing is, the global uncertainty of, something could happen beyond what's happened. So we had these, some of the bank failures in US. And then in Europe, what happened, the merger. So, you race back in time, you suddenly start thinking what happened in the past when bank failures has happened. So, suddenly it opens up a Pandora's box. Anything could happen kind of a thing, because we have seen the global financial crisis, what happened after that. Okay. But so the contexts are different this time around in the sense that we are at the peak of the leveraging cycle at that point in time. And these banks had piled upon toxic assets and that fell apart and everyone was impacted. But this time, if you look at it, what is happening is the larger banks are actually getting stronger. They are seeing a massive shift in deposits from those weaker banks to the larger banks. So the big banks, which actually matter for the markets, are actually getting stronger, basically. So, and we are not in a stage where we are in an overheated economy, as it was in the past. And banks are not holding toxic assets. So I think that it's a little different, but the fear is there of something might happen like it happened last time. And that's actually, it's so overwhelming that you could be forced to ignore the positive high frequency data that's coming month by month. So if you look at for March, GST is 1.6 trillion. No one is even talking about it. And that's not the March effect because that will show up in April, right? It comes with a lag. And if you look at both the PMI for manufacturing and services, it's pretty robust. I mean, it's one of the best globally. If you see the PMI global charts, I mean, we are outperforming significantly, and credit growth at 16% is doing quite well. So overall power demand and other things, we are seeing steel, cement in the domestic market, they're looking pretty robust. And the real estate cycle, that's one of the best in several years that we are seeing. So I think because the overhang of something terrible might happen globally, which will impact domestic demand very badly, is playing on the mind. And it could be right, but we don't know basically. So, but the point is, you could completely ignore what's happening positive in the domestic economy. So that's the type 1 error, that you completely reject some facts which are coming because you have some assumptions about something else.
We spoke to Amitabh Chaudhary of Axis Bank yesterday, and he's of the view that Indian economy is slowing down. The credit growth will get compromised. Deposit growth is low. So if growth is going to get compromised, and if credit growth will slow down, do you think we now need to brace ourselves for more slowdown, more earnings cut? Because if banks are lending less, it will have a spill-through effect going forward.
Who is forecasting is looking at the uncertain environment. So the forecasts are all getting a little lower, but as I said again, these are kind of guesses, and we know what happens to guesses. So the point is, you look at data, how it's panning out, and are there reasons to believe that the slowdown will be massive in the domestic economy? So if there are reasons to believe, one should start building those cases. But currently what is happening is the developed markets are slowing down. So obviously the export side of the economy, that will show weakness. So that part of the economy will be impacted. Stocks which are there in those segments will see slowdown. But all high frequency indicators for domestic economy seem to be quite robust in my view. I'm not saying they're just in a bull market or something like that, but they're quite robust as of now, as we speak.
Then, Vinod, what is the market analogy and what's the market thesis? Sectors that you're still bullish on, recommend buying even at the current levels, or for that matter, what is it that you're avoiding in the market right now?
Yeah. So clearly, as I said, where there is growth risk, which is sectors and stocks which are exposed to global demand, clear risk over there. But what we are observing is the domestic economy in terms of the capital-intensive sectors, which is basically your be it your capital goods, utilities, commercial vehicles, and pockets of discretionary consumption where we are seeing the resilience going on. It's not all round where consumption is picking up all around, but there are pockets of overall. So financials is clearly a case where, so for financials, it is three-pronged strategy. It's basically you look at the NPA cycle, you look at the credit growth, and you look at the margins. So I think as of now, I mean, if you look at a forecast, FY24 will be the bottom of the decadal downshift in NPAs, and so on that front, it's fine. While credit growth is reasonably okay, I'm not saying it's like we used to see in earlier cycles, significant growth, but it's 15-16% is moving along, and there will be some pressure. So the NIMs worry is on banking in my view, broadly. But
we seem to be snapping your line. Apologies there. Just going to interrupt you. I don't think we've got you on the best of lines. But yeah, great to get in your views, and great to know that you continue to be bullish in India. And of course, the sectors that also Vinod just highlighted, he's pretty bullish on domestic economy facing sectors, financial, cap goods, utilities, energy, as well as building materials, real estate, telecom, and select discretionary consumption as well. But more on the markets, and here's what Samir Arora from Helios Capital is betting big on.
I expect this year to be positive and double-digit positive. And some of it got delayed a little bit because I was expecting the US to have settled down when I was saying this end of last year, and that has got delayed a little bit. But broadly, you are absolutely right that the worst is over and things are stabilizing. And India is, even though in performance-wise has done badly, we can say, but and that is related to China and others. But every day, if you see books, if you see discussions, if you see Twitter, if you see economist cover, everywhere this issue of China versus US is heating up, and that has a big influence on big picture flows into China and corporates going into China and everything associated with it. And India is a beneficiary on that big picture theme for, it'll be a beneficiary for I think many years, but on the margin, a big deal for India.
Samir, so can we assume that the local crisis, which was largely because of Adani and trade deficit, that's behind us, and global crisis, which was largely because of inflation and US regional banks, that's also over?
I would think out of this, what is happening to the US banks in theory, I don't think is over. We are hoping that the system can handle it, because the actual losses in terms of mark-to-market losses and what percentage they are of US banks, and particularly smaller banks and regional banks, that number may be quite high, which basically means that the system has to remain in stable conditions so that there is no panic triggered by these things. I think that is one angle on which I don't have a strong handle as to how to do it beyond just being a strong, that means for the Federal Reserve or for the FDIC and others to be signaling that they are anyway there for any bank that needs their help. Other things I think are over or getting over.
Samir, for the longest time, you've maintained that you've not liked IT, and that call has worked like a charm for you. But after the bout of recent underperformance, is it time to think contra now?
So far, I'm thinking that I will be able to handle any pain if IT does well immediately, because it's not likely to do very well. It might go up in line with the rest of the market in case I don't mind. But right now, I would not think that why I should step in immediately. First, let's see the guidance of Infosys. TCS, I guess, will not give any guidance. But if you read, like today or yesterday, it came that one of these companies is not honoring commitments to freshers. I think that is as bad as it can get. Now you may say, therefore buy when things are bad, but as you separately see, our Indian system doesn't.
Markets holding strong, that's important. That the breadth, I think, is phenomenally better than what we've seen in a long time. Dr. Hiren Kankai joins us now, Managing Director with Neogen Chemicals. Let's understand from him that the implications of the new deal and how will this change life for Neogen Chemicals. Dr. Hiren, can you elaborate on the licensing structure and the royalty payment arising from the technology license agreement with MUIS and what it means for your shareholders?
We are very happy that we've been working for last almost 1.5 years, and today we are happy to announce that Neogen has entered into an agreement with MUIS, which is a Mitsubishi Chemical Group company. As part of this agreement, Mitsubishi Group, which has been making electrolytes for lithium-ion battery for last 30 years, are going to share their proprietary know-how and experience and manufacturing technology for making electrolytes. So, as part of the agreement, they will be sharing first the technology, the process, as well as the design of the plant, and in return Neogen will be paying like a one-time license fee to them. This is a perpetual license, so can be used as long as the plant is in operation, and up to 30,000 metric tons per annum production will be supported by this license from them.
Morning. Can you tell us how you're looking at the competition within the electrolyte market? Do you think that you will have a first mover advantage, and will you focus on domestic and the international markets?
So electrolytes, of all the components of lithium-ion battery cell production which are required, Electrolytes is one which is always produced at a locally and it's very difficult to import this. So therefore, like internationally also, the electrolytes which are required for making cells in Japan are made in Japan, similarly in China, in Europe. So therefore, electrolyte production has to be domestic. Now, so far in India, there is no cell production and there was no electrolyte production as well. Although we had set up a small facility from which we are already supplying samples to our customers. So therefore, we feel also in electrolyte, each cell design has its own unique composition of electrolyte. So we feel this is where the first mover advantage is very significant. I mean, if I share a similar experience which we had with companies like Thermax, Voltas, Kirloskar for making lithium bromide solutions which are used in vapor absorption machines. We started with this business 30 years ago and we are still the main supplier to all of them. So we believe there will be a significant first mover advantage, and also the domestic supply of this will make the jobs of lithium ion cell producers easier, and they will have the comfort of local supply of electrolyte.
Right. So will the electrolytes that will be produced support chemistries of all kinds or only one particular chemistry?
Yes. So, when different types of lithium cells are being made, there are different cathode chemistries. So some will use NMC, which is lithium, nickel, manganese, cobalt. Some use lithium iron phosphate, and there are other chemistries which may come from time to time. Similarly, on the anode side also you can have different chemistries, but all of these will always require an electrolyte. Of course, the composition of the electrolyte or the specific recipe of an electrolyte will change from each cell design, but overall the electrolytes will be required in all the cathode and anode chemistries. And the plant that we are making will be will have the flexibility to make different recipes and different kinds of electrolytes as per our customer cell design and customer requirement. But yes, it will support both LFP as well as NMC chemistry.
All right. And how do you plan to source the lithium carbonate over, in order to cover large contracts? Do you have supply contracts for this?
Yeah, so we've been working with, world's top lithium producers, companies such as SQM, Albemarle, Livent, for many, many years, like almost decades. In fact, almost from the time world's biggest producer, SQM, started production, Neogen has been buying lithium. So since we are making the non-battery lithium applications for last 30 years, and we are one of the significantly largest importer of lithium carbonate, which is what comes out of mine in India for last several decades, we have gone and discussed with all these top lithium producers that India is now starting to make cell production and we are going to require lithium coming out of your mines, and all of them have assured to supply or get into a multi-year agreement to supply lithium to us. We are just waiting for our customers to finalize their capacities, and once they give us a commitment, we can also go give us a binding commitment to our lithium suppliers, and then we can enter into a long-term lithium supply agreement. But as of now, we have assurance from all the world's top leading producers of lithium to be able to supply lithium what will be needed to make for this electrolyte and the electrolyte salts.
Right. And what is the kind of demand that you see for electrolytes in India, and any specific requirement for NMC or LFP cells?
Yeah, so, depending on the chemistries that you just mentioned, whether it's a NMC chemistry cell or a LFP chemistry cell, the requirement of electrolyte varies. So, based upon our understanding of what is going to be the composition in India, for 1 gigawatt hour, we estimate somewhere around 900 to 950 metric ton of electrolyte will be required. So, what is estimated is that India will require somewhere around 160 gigawatt hour of electrolyte of lithium ion cells by 2030. So, to support this 160 gigawatt hour of cell production, we will require almost close to 150,000 metric ton of electrolyte by 2030. So this is estimated to grow, and this is based upon 30% penetration of EV vehicles in India, that 30% of the vehicles in India are made by EV, as well as some battery storage requirement for renewable energy sector.
Okay, and finally, there's a capex slated for about 450 crore rupees. Are you likely to revise your capex now post these plans?
So, we had announced our own technology based on which we had said to be able to support up to 10,000 metric ton of electrolyte production, we will be needing around 450 crores investment. This also included investment into electrolyte salts as well as for electrolyte manufacturing. So this was our own technology and our own investment. Now that the agreement has been finalized and we have a requirement which can go up to 30,000 metric tons per annum. So in the coming months, we will discuss with our customers. We will also understand the difference between our technology and the Japan technology, and then ultimately come with a revised number of the phases in which we will be doing investment and the amount of the investment for the same.
Right. Thank you so much then. Great to have you today on the show, Mr. Kanani, and highlight what really is going on with Neogen Chemicals. On that note, we're going to take a very quick break, come right back. Lots lined up on the other side.